U.S. stocks were higher Friday but down for the week. Investors were assessing the employment figures that did very little to counter the likelihood of more aggressive monetary tightening. So, on the week, all three major averages were down, and the Dow finished down for the first time in 5 weeks. The U.S. economy added 261,000 Steve Jobs in October, while the reading for September was revised up to 315,000 Steve Jobs. Economists were expecting a smaller payroll. However, the unemployment rate ticked up to 3.7%, which pretty much means nothing. I just include it so that those who still have jobs will feel better. Personally, I'm a quiet quitter, but that's nothing new to older subscribers. In a world where bad news is good news and good news is bad, the employment news has a silver lining. Although the employment number may be disappointing for investors hoping for a dovish Fed sooner rather than later, keep in mind it was the lowest reading in nearly 2 years. So there could be signs that the market is slowing. The other news is that central banks across the globe are moving in lockstep with the U.S. Federal Reserve in combating inflation. What that really means is that since no one knows what to do, let's just follow the Fed down the path to oblivion. And that, my friends, is the news. However, if you want to buy low and sell high, Bank of America has some news for you. The bank's sell-side indicator, which aims to measure the overall sentiment of Wall Street strategists, has fallen to its lowest level in 5 years. According to Bank of America, the consensus equity allocation has been a reliable contrarian indicator over time. While the sell-side indicator does not catch every rally or decline in the stock market, the indicator has historically had some predictive capability with respect to subsequent 12-month S&P 500 total returns. And although the indicator isn't flashing a buy signal just yet, it has reached its closest reading since 2017. So, let's take a look at the charts. Now I keep going back to the charts that are proving to be somewhat reliable. So once again, we're looking at the volatility index. You can see the symbol in the upper left is $VIX using stockcharts.com, and we've looked at this nice dish many times. We're going to continue to look at it because right now these formations are very predictable. Well, they have been. Now, we're coming on down after this top from here. We're coming on down. We have a bit more to go. Let's look for a bottom somewhere near that 22 level. Down here at the lower part of the charts, you can see the MACD, the fast line, is just about to go through the slow line on the way down, which means we have, I would imagine, several weeks here on the downside, but you never know, so keep your eye on it. But the probability is that the VIX is moving down, so the probability in reverse is that the stock market is going to continue heading on up, but we're starting to get a little long in the tooth on this move, so anything can happen. But I still think the probabilities are with the VIX going down and the stock market's heading on up. Let's now go to our charts. And sticking with the theme, this is the 2-year weekly chart on the spiders, the SPY, and the close on Friday was 376.35. As you can see, we've moved off of this bottom here on our way up, but we got reflected right there at the 20 EMA. We got reflected back down here. So let's just see if we can consolidate and continue a move on up. Again, that's what I think the slim probabilities are, is for a continuation of a rally in the market in the next few weeks or so. We need to break above the 20 EMA, the 50 EMA, and perhaps even higher, but of course we want to get above this downward trend line. Of course, here's the channel once again, more or less like that. Those aren't very good lines, but you get the idea. We want to head on up here, certainly past the 50 EMA, and then above this trend line to be convinced that perhaps we actually are in a long-term rally. Right now we're not. Right now this is just a bear market rally, so we have to watch out. There are risks to this rally. Let's move on down and take a look at the oscillators. Volume's not going to tell you too much other than the fact that the volume is declining, not necessarily great with an upward moving market, but the volume still is at higher levels than it was, say, a few months ago. Now here into the MAC, you can see that definitely we had that bottom and basing. We moved on up, we topped out, rolled over, came down. We're trying to bottom and base here with the move on up, but you can see this little hitch here as the fast line is approaching that slow line, that there's a bit of hesitation. We're still relatively negative here at negative 11.05, at least on the fast line, and that's pretty steep down in comparison to the history here in several years, but certainly the lowest level more or less in this chart other than back here. But it is having some hesitation in moving on up, so we got to watch that. I think hesitation could last a week or two, but I think again still the slim probabilities are that we will break through that slow line, continue on up towards that zero line. But risks start to gain here as we continue moving on up and as this move starts to get mature and older. Moving down here into the histogram, you see pretty much the same thing, but definite improvement here. We're continuing on up. We're almost at that zero line, of course, with the fast line just about to cross through the slow line. Let's see if we can continue on up here above that zero line. Now, price rate of change is giving us a little bit of a negative signal with this move on down. It's below that zero line after having been above, so it's below. It's going to do some sawtoothing and perhaps gain some steam to head up and through that zero line once more here in the next few weeks or so. Into the relative strength, actually shows you pretty similar measure here. We're at a moderate 45.63. We went above, gaining some strength. We came on down here with a sawtooth, but perhaps this actually might turn into some kind of a head and shoulders. We'll watch out for that. Actually, it looks like an ugly smiley face. Here into the stochastics, pretty much the same thing. The fast line did bottom, did move up and through the slow line here, and it does show another attempt at a decent bottoming and basing, but we're still well below that 50 or midline, so we need to gain some strength. But things are improving, not really all that well, but they are improving. Again, here into the Williams, we went up to that 50 or midline. We got reflected back down again. I think it will probably gain strength. It will not head down to that negative territory below that negative 80 into that oversold. I think that is not too likely. I think it'll come down here and then we'll reverse and head back on up once again. I think that is the probability. Again, it's not a great probability. It's better than 50-50, but things can change with the election coming up here very soon. Once again, let's see if we can power to steam up and through the 20, the 50, and the trend line. Perhaps a favorable election, and I don't know what that is, a favorable election would bring strength to the market to head on up, but I'm not too convinced that a favorable election is going to happen. So I think we're going to head into some trouble once we get to that 50 EMA and certainly that trend line. I think we'll have to really closely look at that. We didn't have power the last couple of times that we reached that trend line. It got reflected back. I think that is another possibility. Now, in the next update, a week from today, we'll take a look at the long term, the monthly chart, and see where we are, because I think we might have a better chance of possibly picking out a bottom in the market. I don't see anything exactly right now, but I think things are starting to form and we may have a chance for a bottom perhaps sometime in the first quarter, perhaps by the end of the first quarter, but we'll talk about that more next time. And for today, that's ChewDog Charts. Thank you.